So I had figured out that going to work every day cost me $67. So yeah, I was getting poor going to work.
In this episode of Investors and Operators, I'm sitting down with Mike Silva, who is an investment manager at CalPERS and heads up the Emerging Manager Program. Mike, I think you're coming up on 13 years there. And I learned that the entire time you've been focused on emerging managers. So this is for any emerging manager who is going through the process of fundraising. We got a lot to learn here, a lot to talk about. So, Mike, can you just kind of give a lay of the land of CalPERS and the Emerging Manager Program?
Sure. So I've been at CalPERS for 13 years, specifically focused on emerging manager strategies. Early on, those strategies included more of a total fund approach. We had emerging manager strategies in global equity, in real estate, and private equity. So I worked across those asset classes. Um, in over time, that there's been a shift. Most of we believe, at least with emerging managers, at this point, that the opportunity set exists in the private markets. Although, that's just for at CalPERS. We believe that we have a better opportunity for outperformance in private equity, private debt, and real estate. So those are the asset classes that I'm focused on and work across. I lead the emerging manager strategies across those asset classes, essentially advocate internally, and then meet with managers externally to initial sourcing and screening and providing those managers to our asset classes.
About how many emerging managers have you backed in the past few years?
It's a great question. So, in the last 3 years, CalPERS, we've seen a shift with our investment with emerging managers. The arrival of Anton Orlich, the managing investment director for private equity, has really had a led to a cultural shift, at least in how CalPERS views emerging managers. Anton and the private equity team have really shifted away from large buyout more towards the middle market, as well as investing in growth and venture. The first 10 years that I was at CalPERS, there just wasn't any interest, or at least the word was we were overweight in venture. So there was a bit of a lost decade there for investing in that space. And those two areas or segments really lend itself well to emerging managers. You'll see more emerging managers in the middle market as well as in growth and venture. And so we've done, or private equity has done, in the last 3 years, $6 billion with emerging managers, and also 21 billion with diverse managers. But with emerging managers, there were 22 emerging manager and commitments in private equity in those last 3 years.
And then is there a typical way that you invest with them? I think you're mentioning there are like three different ways that you work with emerging managers. Can you kind of outline those?
Sure. So there's, like you said, there's three ways we invest with emerging managers. First, it's directly from the asset class. The asset class will source and diligence and select managers to work with. Uh, the second, the second two are really through the use of an intermediary. So one of those options is the standard fund of fund. So we had our domestic emerging manager funds one, two, and three. Those funds were with GCM Grosvenor. Those are currently out of dry powder now, but those were very successful funds. DEM 2 and 3 each outperformed the private equity policy benchmark and the asset class itself net of fees. So really strong performers and several emerging managers that ultimately made it into the larger portfolio. And then in 2023, we announced $1 billion to a new uh, a new strategy, a seeding and staking strategy, 500 million to TPG and 500 million to GCM Elevate. And those are essentially, we're providing working capital as well as a fund commitment to early stage managers and entrepreneurs. In exchange, we get equity interest in either the firm or the management of the fund.
W- What's been behind the shift toward emerging managers? Like, what is this institutional case for emerging managers?
That's the question that our CIO, Stephen Gilmore, had for me upon joining CalPERS. And I got to be honest, it scared me a little bit because we had
So
never
you've been here for a few years. What do you do?
we have always we had up until that point just leaned on our objectives, which were, first and foremost, we're investing because of performance and returns. And then secondly, it provides access to areas you might not otherwise be invested in or might otherwise overlook. And lastly, for that next generation of investment management talent. But what he was asking for is to really make the business case. And so my team and I, we set about of, really digging in through the research and the data. And what we really found was, most of the capital, the LP capital, is flowing towards large buyout. The significant amount of funds or allocation of capital is towards that large buyout. And that leaves the middle market and the lower middle market very inefficient and allows for opportunity. What we found is that emerging manager or that small managers, first of all, there's a higher dispersion of returns, so it's certainly riskier, but a higher median average in terms of performance. So it's really about manager selection in those categories, and so it's less efficient and it provides easy. There's lower entry multiples and higher cap rates, for example. And there's already an easy exit with the large buyout willing to purchase those opportunities. So the business case is really shows that there is opportunity for outperformance in that lower and middle market area.
Yeah.
That's in
How
private equity, private debt, real estate, and venture is what we found.
how has your team needed to evolve to effectively find the, I don't know, not the diamonds in the rough or the signal from the noise, however you want to do this. Like, how have you guys needed to scale your team or just become better at finding those quality managers? And maybe kind of walk us through just, you know, the manager selection process so people can approach you in the, an effective way and, make things easier for your life and your team.
Sure. Like, our approach to sourcing and relationship building with emerging and diverse managers is intentional. I'd say it's structured and grounded in, the fiduciary discipline. So it's about coverage, signal quality, and repeatability. First, I look, proactive market coverage. I engage directly with emerging managers across private equity, private debt, and real estate, either at conferences, targeted meetings, or through warm introductions. Usually it's through a 30-minute meeting where I get to know just the high level information about a manager. Second, it's partnership driven sourcing, actively leveraging relationships with our peers. So I'm often on a call with New York Common, New York City, Texas teachers, CalSTRS, and I'm working with our consultants and platform partners to really broaden the funnel and understand who the best managers are across each of the asset classes. And then the third is just having a disciplined approach when it comes to screening and evaluation. I'm not spending a lot of time doing a deep diligence on these managers because I'm meeting with, a couple hundred a year, but I need to be ready to provide managers to each of the asset classes when they're looking at certain segments of the market. So, I'm looking for performance to better understand the team and the talent, the strategy. If there's a portfolio fit, you could be you could have great performance and be a great manager with a great strategy. But if it doesn't fit the portfolio, there's no room for a manager. So, portfolio fit, and lastly, alignment of interest. And this ensures that our sourcing, remains more investment led than relationship driven.
Yeah. Can you talk about the first meeting? Got 30 minutes. What are How can emerging managers make the best use of that 30 minutes with you? And the inverse of that, how do they make it a really big waste of time for you?
Well,
Would have been like truly like how can you poorly structure a 30-minute meeting? But let's start off with how can you make the most of that 30 minutes?
well, I would, if I were a manager, for example, I would look at our AB 890 report. So the California legislature mandates that we submit a report on an annual basis on all the emerging and or diverse managers that we make in the fiscal year. So the most recent report was posted online 3 weeks ago, and that includes the last 4 years of investments or commitments with emerging managers. So that's one way to better understand the types of managers that CalPERS has invested with recently. Also, you can go online and find all of our managers that we've invested with. So I would certainly, if I were a manager, try to understand who CalPERS is investing with. What are the similarities and what are the differentiated strategies? So when you're having that conversation, you can point that out with me or any CalPERS team member if you're having that conversation. That's one way. Certainly, doing some research. I think our investment committee meetings are all posted online. So you really want to understand what each of the asset classes are doing. So maybe reviewing, the last 2 years of investment committee. If you're a private equity manager, you want to know how the asset class is approaching private equity in the last 2 years so you can have a more fruitful conversation.
Investors and Operators is the podcast of 51 Labs, a full service digital marketing agency that focuses on private equity firms, the portfolio companies, and others in the M&A market. We handle everything from branding to video to websites, LinkedIn content, and everywhere in between. We've done over 150 projects since 2019, and usually we do a lot of work with emerging managers, so funds 1 through 3, independent sponsors, but also funded private equity firms. Reach out, happy to help out. When you walk us through like an actual meeting of like what's a good way for that to go? Is it starting off with the story of the firm, or is it, hey, just start with results first and where you're at? Of like what's the flow that is most effective for you to really understand who they are, what they do?
Well, I mean, I think first, whenever you meet anyone in the space, I think it's important to be able to have be able to distill the the firm, the strategy, the team in 1 to 2 minutes. And if you can't do that, then you need to really work on it because you've got to catch someone's interest and you only have a couple minutes generally to do that. But when we set up a call, I'm just looking for, I'm looking to better understand the team and the talent that's on the team. How long have the partners worked for each other? Um, who sits on the investment committee? How do they make investment committee decisions? Is it a is it democratic? Is someone able to vote, you know, no or reject a deal? Is it how are meetings run? Is there a healthy rub occurring in those conversations? And how does staff react during those moments? So team and talent is important. Performance is important. It's very difficult for emerging managers, obviously, for to find attribution, but we can certainly, it just that's why emerging managers are a little tougher sometimes because it requires more work, right? More reference calls, more reference checks to better understand who worked on deals and the performance behind each of those deals. But, I think you mentioned it in one of our pre-calls where, there's opportunities for to do sponsored type deals. Performance is important. Um, and certainly that's something that I want to talk about. I want to talk about deals being done or have been done and what value creation was added is important. uh I need to understand the differentiator of the firm. um what there are a lot of managers. What may sound unique to a manager is something that I might have heard, 50 times already this year. And so I think that's important, being able to really communicate what the differentiator is and how you can bring value to a portfolio. So team, talent, performance, um, how you're sourcing deals. I think at least everyone I talk to, has some sort of deal sourcing mechanism. But I do like to learn how managers are getting their deals sourced and if there's anything intriguing about it.
What are some things to avoid during the first meeting?
I think, asking about how our program operates, stuff that you'll find on the website. I provide an update to the board every November. So that's something that managers could also take a look at, not just study what the asset class that their relative asset class that they
Yeah.
are part of, but also our presentations to the board so you can better understand how the program operates and what we're looking at.
I know this is kind of a ballpark answer and question, but if you had to say what percentage of first meetings have a a reasonable amount of research that they've done with you, what would you ballpark that figure at?
I would say it's a pretty low percentage of managers that do that level of diligence
Of
or
like sufficient, not like a whole semester of of research on it, but like, hey, you should actually know this before you meet with me. And
yeah,
you're saying that percentage is actually quite low of people who do the appropriate level.
I would say very low. I mean, and I get it. I mean, managers are already short staffed. They're having trouble keeping the lights on. This is a challenging and difficult time to fundraise. So, I think managers are thinking these are long shots anyway. And so they're not going to put the time and effort to do that. But I also think from the manager perspective, uh, first encounters and first meetings are important. I do think that work is valuable.
Do you think that happens because managers need to do more planning around their LP outreach strategy
I do. I think,
and when to sequence certain, and they just don't know as much as they should around when to sequence certain LPs?
yeah, I think, and not every, at CalPERS, just like on our website, we have an emerging manager page, for example, that just basically tells folks, here's how we invest with emerging managers, here's what we're looking at, and here are our consultants and how you can get a hold of them, right? So it provides them with at least a very basic set of information, and where they can reach out directly to our partners. I'm not sure that managers are aware of that, because not every LP or every large public pension plan has that information on their website, but we certainly do. And I think most of the large public pension plans have their investment committees somewhere on the website. It's like a YouTube type
Yeah.
channel. They can review the investment committees, and you can it's also transcribed, so you can review the text and what was shared. I think that managers are just having a tough time uh, with the time aspect of it. It's tough to fundraise, and they're trying to be as efficient as possible, and that's probably the step that they skip.
Yeah. So after the first meeting, walk us through kind of the next stages, and also like how many people are part of this decision making process for an emerging manager?
Sure. Well, after a first meeting, I'll determine whether the fit is more apt towards one of our partners. So in this case, TPG Next or GCM Elevate, or if it's the asset class, right? And if it's one of our partners, I'm always making the introduction right away. But not every manager is open or interested in being seated or staked or both. And so that most like that puts them in the direct path. And in the direct path, that's a very tough route to go through because um, our asset class has a very strong pipeline of emerging managers. And so, what I do is I try to um, establish a list of different segments of the market and be ready to share those with the asset class. If I find, I'd say anywhere from 5 to 10 managers a year, I might find there's some form of either it's a unique portfolio fit or a unique strategy or, um, a spin out from one of our existing managers that we might find interesting. And those are the ones that I share with the asset class. Um, but it's important for me um, to not share too many because the asset class has got to they have day jobs, right? And they're already reviewing managers, diligencing, sourcing their own managers. So I have to make sure that these managers that I am sharing with each of the asset class rises, meets the level of their expectations, so that I can continue sharing these opportunities with them.
Can you talk about integrating emerging managers in just the larger portfolio? Like, you know, your portfolio is sizable. Like, what is the large LP perspective and just how you integrate these types of emerging managers into the portfolio and kind of like what do they need to know about this?
I mean, they have to have us, the one thing that's critically important, we talked about portfolio fit. That's critically important, but the other two, it has to be a repeatable strategy and a scalable strategy. Certainly, you know, the idea would be, that we can make at some point that we can make commitments, yeah, at that $250 million range, at least. Makes a lot of sense. And that we're able to that the strategy is able to lend itself very well, very repeatable and scalable to get us to that end. So I would say those are the three most important things.
And if it's a first time fund, I know it might depend on like which of the three routes you take, but about how big is the check size or the range?
Sure, I've seen the asset class make as small as, $50 million, but I think that they're really looking at like their low end is probably 75 million, $75 million commitment. With the seeding and staking platforms, I would say that it's also between 50 million and $150 million commitments. And I'd say direct with the asset class, it's like 75 million to, let's call it, 400 million
Yeah.
commitments. Now, those old fund to fund platforms like the DEM, those were 25 to 45 million, what we would call, those are the small commitment fund sizes. And right now, that's probably a gap um, that that we have. And those fund sizes under $250 million. We're looking for ways to address that gap so that we can make commitments, small commitments of 25 to 40 million.
Got it. Any particular sectors or industries where you're spending more time?
I mean, just naturally, the marketplace. There's so many buyout managers and venture. I meet a lot of venture managers. I'm still learning the venture space. I spent my
Well, less on strategy, more like, okay, hey, I spend too much time in healthcare. We're good in healthcare
okay.
and
Yeah,
more about like sector.
no, I'm not agnostic to any particular sector because I'm just trying to be an open door for managers. And if I feel a manager is institutionally ready or institutional quality, I try to meet with those managers, better understand their firm and their strategy. So
Yeah.
very open across the board.
Yeah. And let's say it's a smooth sailing process from first meeting to, you know, commitment. How long is that general process?
Well, that is, that can be anywhere up to, there are managers that have taken 10 years to get a commitment. So where I've met the manager and 10 years later, we've committed to them. But the shortest, I would say probably like 9 to 12 months, right? Because the diligence is going to take some time. And that would be, the best possible case scenario, I'd say, is 9 to 12 months. Because at the end of the day, when we're meeting a manager, we want to see that what the manager tells us on day one is actually happening later on down the line. Um, and that builds trust. I think one of the biggest misconceptions out there is, establishing a relationship. And the relationship is important. And this is a relationship. You can say it's a relationship business, but the relationship really starts when there's an exchange of capital, right? And that's when you can really begin building those areas of trust. But when you haven't done that, um, doing what you say you were going to do is a good way to begin that relationship.
Maybe shifting gears a lot. You know, you've been there for coming up on 13 years, but let's go way back. Like, what's your story?
So my parents moved to the United States in 1971. They immigrated from a small island, Portuguese island, Madeira. You can see Ronaldo, the pride of Madeira, behind me right now. So my entire family's from there, and they immigrated into San Diego. Really strong Portuguese community there. My father worked as a commercial fisherman, as a navigator, and grew up in this really cool area called Point Loma. And Point Loma is about a mile from the beach. And I grew up spending a lot of my time at the beach, bodyboarding, surfing, body surfing, and a lot of free fun there when as a kid. And that's something that I definitely miss. The ocean, something I definitely miss being here in Sacramento. But yeah, I know I went to Point Loma High School, which has been around for over 100 years.
Yeah.
I really enjoyed my time there, and then graduated and moved on to
Wh-
Sacramento.
What did you think that you were going to be when you grew up, when you were in high school?
Well, I mean, I envisioned some kind of like either like a lawyer or sports attorney, something like that, because I had limited access to when you're growing up, particularly you know you know, parents are immigrants, so uh, limited education, high school education, of course, but no college education, and so you just know basically doctor, lawyer, and there's basically no third. So you pick one of those, and that's kind of what you see. Take some time to really realize all of the opportunities in front of you. But
Yeah.
investing was certainly wasn't one of those. I hadn't even heard of private equity until much, much later in life.
So you went to college, and what did you study at UC Davis?
Sure, I studied political science and history, double majored there. Thought I was going to go to law school, and worked for. I coached little league baseball at UC Davis. I did that for 5 years. Won two city championships, by the way.
Yes.
And my 10-year-old team and my 12-year-old team. So majors and minors, city championships. And I'm particularly proud because those 12-year-olds, like six of those 12-year-olds, ended up being on their Davis High School baseball team, and they won sections for CIF for Sacramento when they were 18. So I took a little bit of that as part of my little league coaching career. Uh, One of the dads there, though, worked for one of the largest political governmental law firms, and so I got an opportunity to first start as an intern and then work there for a couple years. And it didn't take long for me to realize that the law was not something that I wanted to get involved with. It was a very successful, uh, work experience because I learned a little bit about what I didn't wanna do. Uh, and then I transitioned into public affairs, worked for several public affairs firms doing, statewide campaigns and initiatives, and ultimately went to work for the Department of Insurance. This was over 25 years ago. So 27, 28 years ago, went to work for the Department of Insurance, was an information officer, and realized that I wanted to try something different. So that's when I pivoted to more of a investment related background.
And then, so what was like the first investment related role that you had?
So I went to work for a commercial real estate broker here in town, Randy Getz. Randy Getz's investment team with CB Richard Ellis. It was
Yeah.
meant and designed to be more of a 3 year, mentorship. But after a year, I felt like I had had it figured out, or at least I thought I did. And I went to work a year later for Marcus and Millichap, investment brokerage, and did about, let's see, we did um, a commission, against, I was getting a certain amount against future commissions. So I had figured out that going to work every day cost me $67. So yeah, I was getting poor going to work. And that lasted for about 16 months. And I really was, struggling at the time, thinking like, how much longer can I do this? And how am I going to convince someone, having never sold a commercial property or anything for that matter, to list their property with me? Uh, I found, I after a lot of hard work and working on my pipeline for sure, I found someone. I listed a property in Sacramento and sold it for, at the time, lowest cap rate, highest price per square foot in the area. And suddenly all of the work that I had done in the previous year and a half just came to fruition. And I had a very successful career in commercial real estate. But I realized
And you
that,
did that for 7 years.
yeah, I did that for 7, 8 years, but I realized that I needed,
How bad did it get? Like, were you looking at the bank account and like, I don't know how
well,
this is gonna
my
work.
my debt, like I was borrowing $2,000 against future commission after 16 months. I was like, I owe my employer $32,000, like, and I haven't made any money. So, certainly living very frugally during those times. But it got pretty bad. But you know what? Things got really good, and I had a really successful career. But I realized that I wanted to be on the other side of the phone, and so I put together with partners, raised capital, and did basically two sponsor deals. One was a medical office building in Sacramento, and one was a strip retail center in Davis, California. So, put together partners, was one of the managing members, and those were both two deals that I sourced, and together with partners, we did an exit strategy, and certainly had a strategy of how we were going to add value, a value creation strategy, and then 2007 and 8 hit, the great financial crisis hit. And we purchased those properties in '06 and '07. And so our timing was perfect,
Flawless.
flawless timing. And I think I want to say about 80% of properties purchased during that period went back to the bank. I'm particularly proud that neither of those two did, and that we, sold those both at profits for profits and returned capital to our investors. So I understood what it was like, or I do understand what it's like to raise money. Now, not a lot of money, but $2 to $3 million is, for me at that time felt like a lot. And it certainly, I felt the weight of the fiduciary responsibility because it was friends and family and their family. And I certainly felt that heavy weight
It,
of fiduciary responsibility.
it's interesting, like when you bring that up, because I was talking to someone who um, had a key investor drop out and known the person for a long time. And I was like, man, like I raised 175,000 for my first venture, but the emotion that you're feeling, I know that exact emotion. I know what it's like to look at that shot clock, to look at the bank account, and whether you're raising 100,000 or 100 million, the highs and the lows are emotionally the same.
It's
And and
incredible.
having to convince somebody and put your reputation out there, and then when you have that low, the question is like, what are you going to do? And like I remember ruminating when I was, someone didn't come in for 50K or 100K, and this is for like a seed round. And like it's like, okay, well, what are we going to do next?
Yeah.
Am I going to spend the 13th night or the 14th night really thinking about this? Or am I like, all right, game on, let's go on, move on.
It's really tough to fundraise. And but when you do get that money, then it becomes really tough. That weight of what's the expectation, right? And
Right.
how you manage their capital. And being a steward of capital, I think is a great responsibility.
Yep.
And that's something that I look for in managers myself. Will this person be a good steward of capital? Again, that goes back to um, doing what they said they were going to do, right? I think, and establishing that trust. So I had those, part of those, both those deals. I was fortunate that both of the financing on those deals were tied to LIBOR at the time, so the interest rate stayed pretty low, and we did all right. We sold those out. It took some time, obviously, to dispose of those assets, but really proud of that work there. And but when the GFC hit, I pretty much knew. I always wondered why there were there seemed to be a lot of young commercial real estate brokers and a lot of old commercial real estate brokers, but nobody in between. And I figured it out that not everybody can ride through those cycles, right? And the ones that do, like stay in the game, stay in the game for a very long time, and the ones that don't, they're out. And I knew that I did not want to ride out a 5 year cycle, and I was lucky enough that this position with CalPERS was open because it required, I had the legislative background, I had the public affairs background, and there is a part of this role is like, you know, representing CalPERS. So it requires a level of diplomacy. Many people think that the emerging manager program, um, there are politics tied to it. Now, I've always said, to me, if you're investing with emerging managers, the politics never comes into play. But certainly that stakeholders like the legislature, the board, and other stakeholder type of organizations that represent members, certainly they have an interest in these types of programs, so they do care. So there is a part of that that is required for the role. But I also had public and private investing experience or a basic knowledge of those of how those mechanisms work. So this job was kind of the perfect role for me, and I consider myself incredibly lucky to have landed at CalPERS um, for my
Yeah.
my what I hope will be a long 20 plus year career here because I really love this organization and the work that we do. I love our mission and what we try to set out. And I love the people that I work with. They're all much, much smarter than me.
What do you think is the difference between you now as an investment manager versus 13 years ago?
Oh, that's a great. I mean, I mean, I certainly think I've developed pattern recognition. I mean, would, or I would argue that I've seen more or met with more managers than anyone at CalPERS. And when I say met, again, these are 30-minute meetings, right? Or, 20 to 45-minute meetings where I'm meeting with a manager and I'm understanding their firm and their strategy and their team and their talent. I think I've met with anyone more than anyone at CalPERS, and that's given me a sense, you know, that thin slicing, that ability to thin slice a manager and recognize that they have a differentiated strategy, or that there's some hunger or something that sets them apart from the rest of the people and managers that I meet. So I would say that would be the biggest thing, and I've that's taken time to acquire, and I'm really it's a skill set that I'm really happy that I've been able to gain.
If you had to give if you had to give 2 or 3 pieces of advice to emerging managers as, they're kicking off their fundraising and their journey, what would that be?
I mean, I think it's really important for managers, especially the smaller managers, if they're raising under $150 million, to really focus more on endowments, foundations, and family offices. Really, those are those folks are investing at this lower middle market. They're investing in smaller managers. They're investing in small fund sizes, and they're more appropriate than the larger LPs. I think, you know, even 150 million for a large LP is a lot. I think that's one of the also another misconception, right? Everyone thinks, well, CalPERS, you know, $600 billion. They certainly have the ability to invest with emerging managers, but really, it's actually makes it more difficult from a scaling perspective, right? When you're doing one $500 million investment versus 10, $50 million investments, that requires 10 times more due diligence. And then if you've committed to those 10, or you commit to 10 in 1 year, 10 times more monitoring. And in the second year, you do that again. Now you got 20 and two. In the third year, now you got 30 and three, and you're monitoring all of those. So it does, these are resource um, constrained. CalPERS is certainly resource constrained in its ability to manage these small relationships. I think that's something that managers should be aware of. Really put your energies in focus. Understand who the gatekeepers are, whether it's at a family office, endowment, or foundation, or a large LP, and understand how they make investment decisions, and really try to understand their portfolio and where there's a potential gap and how you might be able to solve a problem.
And for my final question, what why do you do this? You've been doing this for 13 years with emerging managers. Why do you like working with them?
I believe I meet so many talented early stage emerging managers, and so I just have a passion for this work. I advocate for emerging managers, like I said, internally, but externally as well. And I really believe there's an opportunity for outperformance. I think that's where the alpha is. And I think if you trust in your conviction in manager selection, then there is alpha to be had out there. And our private equity team is proving that. I think they rank number one um, in the 3, 2, and 1 years as it relates to private equity performance compared to their peers. And that is um, because of their manager selection skill set. And a big part of that is their investment with emerging managers.
I love it. All right. Well, this has been a wide ranging conversation. Is there anything that we have left out?
No, I mean we even got to mention my boy Ronaldo back there. So I feel the only thing is let's go Padres. Baseball starting up this week, so that's my baseball team. And when football starts up, I'm a Chargers fan, and that's about it.
There we go. I'm from San Diego, so I'm right there with you. All right. Thanks so much for doing this. Appreciate it.
Thanks, Jordan. Appreciate you.
All right. See ya.